All right, welcome to another Finance Friday weekly wealth creation course. I'm Jerry Fetta, owner, founder, CEO of Wealth DynamX, and I'm here tonight with all of my homies on Zoom, on Facebook. If you guys are watching on YouTube, I'm here tonight to talk to you about index universal life insurance. Okay, now I want to make this kind of like the Bitcoin video I did, meaning I want to keep this very, very casual, very objective, and just give you my opinions on it. Now, before I dive into it, yes, I am wearing glasses. So that's new. Someone called me Miss tonight, like MISS, like as if I'm a female. They called me. The guy was like, "Excuse me, Miss," but I have these ugly glasses and the beard going on, so I don't know how they did that, but that occurred tonight. But anyways, I'm going to talk to you guys about index universal life insurance. As always, and I'm going to give you guys a couple of new ground rules, but as always, make sure that you have a purpose for being here tonight. Understand why you're here, why you're watching. Sure, it's entertaining, sure, it's fun, but have a reason to be here, right? And think about application. How are you going to apply the information? Now, tonight's going to be a little bit different because, it's knowledge that you might not apply in the sense that you're going to use it, right? Like if you're a client of mine, you're probably not someone that owns index universal life insurance. And so when I talk to you tonight, you're probably not going to be like, oh, I need to go cancel a policy. That's probably not going to be, the moral of the story. Right? But it is knowledge that you have now. And so you can use that knowledge to share the truth about money with others. If you know others that are like, you're like, hey, this might be something they want to check out, right? So figure that out before we get started. We will be covering lots of technicalities, terms. I wish it weren't that way. Index universal life insurance, in my opinion, is one of the most complex financial instruments in existence. So with that, there's just going to be terms that we have to go over. So I will do my best to simplify it. If there's anything that I say that doesn't make sense, things that you want me to cover, go back over in order for you to gain a better understanding. I'm trying to get this light out of my eye with the glass reflection here. I'm an amateur glasses wearer. But if there's any questions you guys have, things you want me to go over, be sure that you drop those in the comments. I want to be hyper aware of making sure you guys are tracking with things. And then finally, be a producer. If you're on this, number one, if you're a client of mine, we're going to talk about IUL, index universal life insurance. Doesn't mean they're bad, and it doesn't mean the people that sell them or own them are bad or stupid or any of those things, right? So be positive in that aspect. If you're not a client of mine, be positive in the comments. If you're an agent, definitely be positive. You might be someone that sells it or owns it, right? So this is not me talking to you about your personal choices. This is just me sharing my opinions and viewpoints, okay? I'm not your agency owner. I'm not your upline. I'm not the person that's going to have this discussion with you on whether it's the right thing for you to sell to people or to own or not. And so that's something that I want to make sure we hit right off the bat as well. Now, without further ado, let's jump into our course. So the topic again is index universal life insurance. We will be doing some, Nano says the glare is just part of having glasses. We will be doing some clearing of terms. Okay, so I'm going to draw this out. We have the word index. We have the word universal life. This is actually one term. And then obviously we have the word insurance. Okay. Just right there, like we could do a whole course on just what these words mean, right? The first thing that I want to start with is I want to actually start with what is universal life insurance. Okay. Obviously, we know what insurance is. Okay, we have insurance so that we can spread out risk. We can use the insurance company's money in lieu of our own. That's why we have car insurance, right? So that if we get in a wreck, the insurance company pays it out of pocket rather than us. Okay, and it financially protects us to a degree, right? Now, we also have health insurance. We've got disability insurance. We've got identity theft insurance. We do have life insurance, right? So most of us are familiar with what insurance is. In just the broad scheme of things, insurance, like I said, is a way to defend against risk. It's a way for you to defend against risk in your own life using an insurance carrier, using one of their programs. Now, what is universal life insurance, right? So the tail end of that is life insurance. Life insurance means that you pay a premium to an insurance company for the period of the time you pay that premium, whether that's a temporary period of time where it's 10 or 15 or 20 years, or if it's for your entire life, the insurance company, as long as they're solvent and in business, they're obligated to pay you a death benefit or pay the insured a death benefit if there's a death, right? So within this, we have, I can't scroll on this. Within this, we have a couple of parties. We have the insured. This is the life that we're covering, right? We have the owner, right? This is the person that actually owns the policy. It's theirs. They're the one that created it or took the policy out on the insured. Then obviously we have the beneficiary. Okay, this is the person that's going to receive the death benefit. So when the insured passes away, the beneficiary receives the death benefit. And then the fourth party that we actually have is the insurer. Okay, this is the group, the entity, the corporation that's on the hook to pay out that death benefit, right? So these are the four groups involved in life insurance. We've got the insured, this is the life that we're covering. We've got the owner, we've got the beneficiary, and then we have the insurer, right? So want to establish those. The purpose of life insurance is that an owner of a policy will take out a policy on an insured covering that person's life, okay? And then the insurer is on the hook to pay out a death claim. If the insured passes away, this beneficiary is going to get a death benefit. That death benefit is owed by the insurer, right? That's what life insurance is about. Now, within life insurance, there's what's considered temporary life insurance, which is also called term. It insures you for a temporary period of time, right? And so what that means is you can buy life insurance that covers for 5 years, 10 years, 15 years, 20 years. I've seen it all the way up to 35, I think even 40 years back when I used to do term insurance. And then you also have what's called annually renewable term, which means it covers you for 1 year. And then every year you can renew and every year it gets more expensive, right? So that's called temporary insurance. Then you have permanent insurance, meaning it's going to be around forever as long as you pay the premium, right? Now, the way that this universal life insurance works, universal life insurance, this actually became popular back in the 70s, I believe, 1970s. And so basically what this was the insurance companies were coming up with a alternative for whole life insurance. Whole life insurance is permanent. It means it's going to be a level premium, never going to go up. The insurance company has to pay it out. It's guaranteed. So if you put yourself in the position of the insurance company, let's say that I'm the insurance company and you take out a policy with me and it's a whole life policy. Let's say it's for $2 million. That means for 100% sure, I have to pay $2 million out to your beneficiary at some point, right? Then it's just a question of, well, how long does the insured live, right? How long is this person going to live? So the insurance company, what they're looking at is they're hoping that, and this is why they go through all this underwriting. If you've ever done life insurance, you've noticed that it's medical exams and all this different stuff, and they want to have you pee in a cup and know everything about you and take your blood. The reason why is the insurance company does not want to have to pay a death claim to the beneficiary early in the policy, right? Think about this. The insurance company, they're saying, hey, $2 million in coverage, you're going to pay us $500 a month. Well, if the insured dies in month 1, the insurance company is going to go broke. They can't pay out $2 million when they only collected $500, right? So they mitigate the risk by underwriting and saying, hey, we're going to make sure that, statistically, everything is in shape with this person's health. And we know that they're going to live a long time. And if we pay this death claim, it's going to be the later part of their life, not the earlier part of their life, right? That's what underwriting is about. Now, with whole life insurance, they spread that cost through a premium, right? When you pay an insurance premium, that premium is basically giving the insurance company the amount of money that they need to operate, to build up their reserves, to make sure that when that policy does pay out, they have the cash on the books, meaning it's in their accounts and they actually could pay the death claim, right? So insurance, and when you look at whole life insurance, which has been around for hundreds and hundreds of years, this is what everyone has always done. This is what they've done since the 1700s and earlier, right? They had, like a flat level cost. And what happens is the insurance company, they take part of that money, and that goes to the cost of insurance. They take part of that money that goes into the reserve account. Okay. And that builds up what's called a cash value, right? So we have, let me sketch this out a little bit. We have, let me figure out how to handle hands, lower all hands. Good. We have the cash value, right? Let me go ahead and erase some of these things here. We've got the cash value in a policy, which accumulates over time. And the way that this basically works in a very simplified context is you have your death benefit, right? You have your death benefit, you have your cash value. Let's say the death benefit is $2 million, meaning the insurance company will have to pay out that $2 million at some point in time. When you pay a premium, a portion of that premium, like I said, pays directly for this death benefit, A portion of it goes into reserves. Okay. Now, this can be very, very different from policy to policy depending on design, but just a portion goes to each. Now, what the insurance company does is they want to make sure that they have to pay out the death claim. It's going to be down the road, or they want to try and get the policy off their books. One of the two. They never want to have to pay a death claim early, and if they do pay a death claim, they want it to be when the person's old and they've had time to take these premiums and invest them and make profit and make sure that they've got the cash. Right. And so they have this thing called a cash value. The cash value quite literally means the insurance company is saying, hey, this is the amount of money we would pay you to surrender your policy right now. Right. Like if you just dropped it and we didn't have to pay you out, this is the dollar amount we would give you today to do that. Okay. This now exists as an asset. So you can borrow against this asset called a cash value. The cash value grows over time. Right. The death benefit might remain level. It might go up, it might go down depending on your policy structure, but the cash value goes up over time. The premium stays level the entire time on a whole life contract. Okay. So back in the 70s and 80s, what was happening was people were buying these whole life policies, right? And so the insurance company, they take the premium and they invest it. Okay. And then they have the obligation of having to pay out the death claim. Well, a lot of people in the 1980s, it's a very high dividend environment, high interest rate environment. People were taking cash value loans. And so what was happening was the insurance company was having to loan these reserve funds to the policyholders, right? And so the insurance company, they're not making as much on these loans as they could make investing. Think about it. You could loan a cash value dollar to a policyholder. Back in the 80s, maybe they were making 9%, right? Or you could throw it into, like insurance companies are huge. They like Mass Mutual funded Walmart before it was Walmart, when it was just back when it was Stan Walton, right? Like these are the kind of deals they could do. So there's this opportunity cost of, okay, we loaned money to insurance to the insured through their cash value. We now can't invest that money elsewhere because it's in their pocket, right? They are paying us interest, but that interest is significantly lower. Okay. And so they were looking at this as a loss. They were saying, we need to get rid of this. We need to find a way to get the insured to a position where when they're later on in life, they're not borrowing against their cash values, because the insurance company wants to make as much profit as they can while they have the money. So they came up with this thing called universal life insurance. Okay. Universal life insurance. Now, universal life insurance basically is a couple of different components. Let me erase my scribble here. Okay. So a universal life insurance policy is still premium, right? You still have a premium. You still have a death benefit. And you still have a cash value. Right? The premium is called annually renewable term insurance. Okay, we just said on a whole life contract, it's level. Your premium never goes up on a whole life contract. On annually renewable term, it starts at really, really cheap. Cheap meaning it might be 10 or 20 bucks a month for like several $100,000 of coverage. Okay, right off the bat, that sounds better. My insurance costs lower. I like that. That sounds great. Okay, which means if the premium is cheap, there's more excess left over to go into the cash value. You understand? Because we're spending less on premiums. So far sounds pretty good, right? The problem though, back in the 80s, is this cash value on a universal life contract. The growth of this was based on interest rates. Meaning they were looking at the interest rates in the United States of America, and they were looking at them globally and saying, okay, we're gonna do whatever interest rates do. Now, back in the 70s and 80s, you could put money in a bank account and make 9 or 10%. Interest rates were crazy, right? You can't do that today. So if you look at a chart and you look at interest rates over time, what happened is they started dropping. Okay, so we have the interest rate performance. This is dropping, which means the cash values are not performing as well over time. Right? They thought we were going to have 8 and 10 and 12% interest rates forever. That was just normal at that time. So people were like, so you're telling me I can put, $300 into this policy, only like 20 of it, let's say, for example, is going to go into the premium, which means I've got $280 left over, which goes here. Where do I sign? Right? And I've got a death benefit. Like, it just sounds great. And so people were doing this because on a whole life contract, the premium is more expensive. You're getting dividends instead of interest rates. The interest rates were competing with and sometimes beating the dividends. So people were looking at these policies and saying, man, I can make 12 and 13 and 14% Why wouldn't I do that? Now, what people didn't understand is annually renewable term insurance means every year it renews, right? Every year when it renews, you are re-signing your insurance contract and you're a year older, which means your cost of insurance goes up every single year, right? So you have a rising cost of insurance. Rising cost of insurance. This is going up, but this is going down. Remember, we said the performance of the cash value is dropping over time, but over the same period of time, and actually in a linear fashion, your premium costs are going up. Okay. Now with the universal life contract, they don't send you a bill in the mail for the difference in your premium. What they do is they pull it out of your cash value. So if your premium went from $20 to $25, this $5 difference is coming out of your cash value. It's not coming, they're not going to send you a bill and saying, hey, you owe us. They're just going to pull it out of your cash value. So what ended up happening, this was back in the 70s and 80s, these policies actually started cannibalizing. People were funding them. They were putting money into it. The internal costs, guys, on annually renewable term insurance, and this is, again, nerd stuff with insurance world, the premiums get outrageous. When you turn 50, 60, 70 years old, guys, we're talking thousands per month, thousands of dollars per month in insurance costs, which is increasing at a rate that's faster than what your growth is. The growth was dropping. We went from 12% interest rates down to right now, we're at like 2. Sometimes some areas we have negative rates. Okay. So needless to say, back in the 80s, the universal life contract was one of the highest sold contracts, meaning the agents were selling them like crazy because it just sounded so good. What they didn't realize is that the interest rates were going to drop. The cost of insurance was going to go up. And grandma, who put all their life savings into the account, all of a sudden doesn't have anything. And what ends up happening is the policy lapses. The increase in premium comes out of the cash value. Eventually it drains the cash value. There's no cash value left. And now grandma has a $4,000 check in the mail saying, hey, you have to pay this new monthly premium or you can't keep your policy. Okay, now take a moment there. Grandma didn't know that that was going to happen. The agent that sold it also didn't know that that was going to happen. Realize this hadn't existed before, right? Do you know who did know this was going to happen? The insurance companies. Guys, insurance is designed by actuaries. These people eat, sleep, breathe, live lifespans and statistics and risk. They understand all of this stuff. They designed a policy that solved their problem. Their problem was elderly citizens were taking policy loans, reducing the performance of the insurance company's portfolio, therefore reducing their profit. The way that we get rid of that is we have a cost that depletes the cash value, which is 100% profit to the insured, and we make sure that that policy lapses before the insured dies. This was designed on purpose that way. Now, this is not index universal life. This is just universal life. This was back in the 80s. Guys, this turned into lawsuit city. In the 80s and the 90s, families were realizing they got taken advantage of. The agents didn't know what they were doing, and they were having exactly that happen. They were losing all of their money. These policies were lapsing, right? So all these lawsuits pop up, and then basically, like, universal life insurance kind of goes silent, right? Interest rates are throughout the 90s, they're very low. In early 2000s, they're getting even lower. And so people kind of stopped selling universal life insurance because of that reason. Now, getting into the 90s, what they did is they actually switched this up, right? So they said, okay, so we're not going to do universal life insurance anymore. We're going to do something called variable universal life insurance. Variable universal life insurance, which is, in my opinion, worse. Okay. But this is what they did. They had same thing. They had a premium, right? They had a death benefit. They had a cash value. Okay. And so you would do the same thing. It was annually renewable term, same exact story, right? They had the death benefit associated with this. This would, be, whatever the premiums bought you. The difference would go in the cash value, except for this was variable, meaning it actually went in the stock market. See, the insurance companies, they said, okay, well, we got in trouble last time because interest rates dropped, but what's not going to drop? Stock market. Stock market always goes up. It's not going to drop. So instead of investing the cash value in interest rates and having that be the crediting system, we're going to invest it in mutual funds. Okay. Which was great. Think about the late 90s, the tech bubble. Could you imagine you're paying, again, $20 a month And that's your cost of insurance, and you're getting your death benefit, and the entire difference goes into your cash value, and the cash value is in the stock market in 1998, 1997, when everyone was making money in the stock market, right? Universal life insurance was back. People were selling them again. It was variable. People were, but the problem was what happened in the late 2000s? Tech bubble, right? Market crashes. They still kept these around, but what happens is with the old universal life insurance, at least your cash value wasn't variable, meaning if it's just an interest rates, it's much like a CD, right? You're either going to make money or you're not going to make money, but you're not going to lose money on the performance of cash value because it's just an interest rate. But when we're talking the stock market, you can lose money, right? If the stock market drops and your cash value bought a certain amount of shares in the market, your cash value is going down with it. And so when markets crashed, what would happen is we still had a rising cost of insurance, right? The performance of the cash value not only would drop when the market went down, but the actual value of it would drop. So you have an increasing cost coming out of a depleting pool again. Same problem. The difference was, though, the insurance company could charge management fees. They liked that. They could charge, guys, I've seen on variable universal life insurance contracts, I've seen up to like 4 and 5% annual fees. Like that's not the cost of insurance. That's fees. That's management fees and mortality fees and this fee and that fee and all these expenses that the insurance company charges to be able to have the cash value invested in the stock market. All the bells and whistles and everything, right? Now, what ended up happening, Nano says it's worse than investing in a 401k. That's true. It's worse than investing in a 401k. Okay. So what ended up happening is we had 2008 through 2009 happen, right? Who remembers in 08? I was in 10th grade in 2008 when the world financial system collapsed. Everyone was getting bailed out, right? Like Lehman Brothers went under. The insurance company AIG, their securities department was actually the one that like got in trouble with all of these mortgage-backed securities and all the stuff they were doing in 2008. So the financial world took a hit. And so in 2008, 2009, all of these people that bought variable universal life insurance, they got spanked just like the people back in the 80s did. Okay. Now, at this time, they didn't get regulated because all the insured, all the owners, they would sign a disclosure saying, I realize I'm in the stock market and I realize I could lose money. They probably didn't know the gravity of what that meant, but that's what they were signing is, if you guys screw me over, I understood it could happen. Therefore, it's fine. Right? That's in the contract. So what happened though is the agents were like, I don't know if we want to sell this anymore. Okay. And so the insurance industry back in the late 90s, there's a company called Transamerica. I used to sell for Transamerica way back in the day. Back in the late 1990s, I think it was like 1998, 1999, somewhere in that range. They created a product very quietly. It was not popular yet, called Index Universal Life. Okay. This was created back in the late 90s. It kind of just stayed back there. Not a lot of people knew about it. Nobody was really selling it, just Transamerica. 08 happens, and the insurers that were selling variable universal life, same guys that were selling universal life, they're saying, okay, well, what can we sell? People don't want to be in the market. Our agents don't want to keep selling this stuff. They don't want to keep having people getting ripped off. What could we do instead? And then they realized, what about this index thing Transamerica is doing? Okay, how could we create this? If you look, most of the universal life contracts were created right as I got into the insurance industry. Okay, 2009, 2010, 2011, 2012. I think I got in 2011. Okay, right when IUL was hot. So what they did is they said, okay, we're going to use something called an index. Okay. So track with me. Universal life insurance, the cash value is based on interest rates. Variable universal life insurance, the cash value was based on the stock market. Okay. Index universal life insurance, and this is where it's going to get very complex and confusing. So bear with me. The insurance company collects the premium, right? They have a certain amount that's going to go towards their death benefit. And then they have a certain amount that's going to go towards the cash value. Okay. This cash value has to be invested. Now, the way that an index works is they say, hey, we're going to base the growth of your policy on the stock market. Let's say it's on the S&P 500. Okay. Now, the key word here is we're going to base it on the S&P 500. It's not in the S&P 500. We're just going to base it on the S&P 500, right? Now, what that means is when the S&P 500 goes up, you're going to get something called a participation rate. These are usually anywhere from 50 to 100% of whatever the market does. So when the S&P goes up, you're going to get a percentage of the upside, right? Now, we're also going to give you something called a cap, which means that you're only going to get up to a certain number, right? So a cap might be 12%, meaning if the participation rate is 100% and the cap rate is 12%, if the market goes up, you get 100% of the growth up to 12%. You don't get anything beyond the 12%. Okay, so upside is 12%. We're also going to give you something called a floor. This floor is often 0 to 1%, meaning if the market goes down, guess what? You can't lose money because you're not invested in it. You're going to get credited with either a 0 or a 1. Okay, so we look at this and we say, okay, how great does this sound? Universal sounded awesome, was a bad idea. Variable sounded awesome, was a bad idea. But this, I can get up to 100% of the upside up to my cap rate and I can't lose money. Again, sign me up. Where do I sign up? Now, this is where I want to disclose. I don't personally like this, and I'm going to talk about why. Okay. Now, if you have one, if you sell them for a living, I have friends that sell Universal Life. This is not me attacking you. This is me just talking about why I would not use this. Okay. So the first thing that we've got to look at is the floor is 0 to 1%, but that doesn't change the fact that you have annually renewable term insurance as the underlying chassis still, right? Meaning your premium still will climb over time, right? There was a study done by, I think it was New York Life Insurance Company or Mass Mutual, one of these guys that we work with quite often. And they did a study and they found that the average universal life insurance policy, index universal life insurance policy, still lapses usually between age 70 to 80 in that range. Meaning that the insurance cost rises so drastically that it does still deplete the cash value, especially if the person's drawing off of it for retirement income, and it does still lapse, which means it is not permanent insurance. Under any sense of the definition, it's not permanent because it will not be there forever. Permanent means it will pay out no matter what. And if you live to, on a whole life contract, if you live till 121, they pay it to you while you're still alive. It's like no matter what, you're getting paid. If you die prior to 121, you're getting the death benefit paid out, right? If you live to 121, they're going to pay it out anyways. Okay. Now, Bobby says it doesn't lapse when built correctly. So there's two different solutions for this. Okay. The first solution is you can have a rider that basically does lapse prevention. I mean, if you pay us this fee, we promise usually for a 10 or 15 year period, the policy won't lapse, right? So that's basically an arbitrary. It's the insurance company saying, hey, Big Brother will take care of you. It won't lapse. Okay. The other way you can do it is you can overfund it in the beginning so that you've got a lot of cash value and then you can have more in there because the insurance costs still will go up. There's no way to defend against that. That's part of the way it works. But if you put enough money in early on and you do that in a high enough volume and you hit a certain metric with it, then the policy, as long as everything performs the way it's supposed to, will still continue to live on because it'll be funded to a degree where it doesn't deplete the cash value. Okay. So those are the ways that you would have lapse prevention. But guys, and again, this is something that we look at. Is this simple? If you're a consumer, is this simple so far? Whole life contract, you buy the death benefit, you put the money in there, you get a certain amount of cash value. If you set it up correctly, 70 to 90% of cash value, you get the rest goes towards death benefit. You're a partner in the insurance company, you own dividends. Okay, here you have annually renewable term insurance, you have a participation rate, a cap rate, a floor rate. We haven't even talked about yet where the actual growth comes from. This is even more complex, okay? The way that they do this index, the way that they get the growth of the market without putting you in the market is the insurance company generally will take, let me sketch this out. They generally will take the cash value, the money that they have in reserves that they know that they need to invest. They put a certain amount of it, typically into bonds. Okay, the majority of it goes into bonds. This is producing a percentage. It's called a yield, right? Now, the difference here, so they'll put, let's say, just to give you a number, maybe they'll put 90 to 95% of it in bonds. The remaining 5 to 10% Again, these are just made up hypothetical numbers, but the remainder goes into options. Okay. What are options? Options is day trading. Okay. Options means like, so you can buy stock, right? But you can also buy a derivative of a stock, which means I can buy the right to buy a stock in the future. I can also buy the right to sell a stock in the future. So the right to buy a stock in the future is called a call. The right to sell a stock in the future is called a put. Okay. So they will take this percentage of the funds and they will buy calls and they will buy puts. And basically what they say is they say, okay, great. When the market goes up, we get a leveraged outcome, right? So when you buy calls and puts, you're buying a discounted contract to either buy or sell at a future price of stock. Okay. So this is something that you have to understand. Otherwise, you can't really say you know how your cash value grows, right? Like who here understands calls and puts? I have a buddy that does, super high level stuff. I understand it well enough to explain to you what it means, okay? But the average mom, dad, business owner, they've got no idea what the hell options are. They've got no clue what puts are. They have no clue what calls are, right? So the idea would be that they buy a call, which says you have the right to purchase this share of stock or these stocks at a certain price in the future. When that happens, right, they can execute on it and they can basically get the leveraged value, and they paid a very small amount to get into it. They didn't have to pay the full price of the stock. So they're getting a multiple of what they paid, right? The other thing that they can do is they can get the right to sell a stock at a future price. So they can do calls or they can do puts, right? The idea would be when the market goes up, this is where your upside comes from. If you can make up to 12%, that's what you're going to get there from calls and puts. If the market doesn't do well, they already know that they've got enough money in bonds that the interest is going to make back what they spent on the calls and puts. They can offset this by selling the calls and puts to other people to reduce their losses. And then they can still guarantee you the 0% or the 1% floor. Okay. Super simple, right? Not really. That's one of the most confusing pieces of shit I've ever heard. Okay. Mark Perry says, I understand options enough to stay away from them. Now, here is the thing, guys. We've talked about, again, we have the cap rate, we have the participation rate, and we have the floor. Cap rate, let's say it's 12%. Guys, this is a gross credit, meaning if the market goes up, you get, let's say 100% of the upside up to 12%. Well, within a universal life insurance contract, there are still fees. You're still going to pay fees for having riders. You're going to pay fees for non-lapse guarantees. You're going to pay fees for overloan protection. And so you're still typically going to pay maybe in the neighborhood of 3%, I don't know, 4% in annual fees. Not including your cost of insurance, because your insurance is still, again, annually renewable term. Okay. So it sounds really nice to be like, hey, you get 12%. But the reality is, if you use an investing calculator and you enter in year one, here's what I put in, and I put this in over time. What's the compounding annual growth rate after fees on an index universal life insurance contract? It's still only going to be 6 to 7%. Still, it's not 12, it's 6 to 7, meaning it's about half of what people think. When people buy these, they buy them on a illustration, and they don't know what the contract says. The insurance illustration basically is made up. On a universal life insurance contract, they do what's called back testing. They say, if this policy existed over the last 40 years, which it didn't, and we invested this way, exactly the way that we say we're going to over the last 40 years, here's what you would have gotten. Well, here's the thing. The policy didn't exist over the last 40 years. You can't claim that future growth is going to be based on the past, number one. And it's even harder to claim that when the thing you're claiming would grow at that rate didn't even exist during that time period. You don't know what it would have done. Right? So the illustration literally is just arbitrary. It's made up completely. It's entirely made up. So what you have to look at is you have to look at any given point, what is my in-force cash value? What have I put into it? What's my bias value? What's my sell value? And then what's the compounding annual growth rate on that right now? Okay. It's not 12%. It's usually going to be 6 to 7. Now the floor, we said this is 0 to 1%. Okay. Also not true. This is, again, a gross floor. If you have a 0% year and you still have to pay 3 or 4% in fees, you didn't lose no money. You lost 3 or 4%. Right? Think about that. On a whole life contract, you cannot lose money. There's no way for your cash value to go down from losses. Sure, you can borrow against it. That can reduce it till you pay it back. All that's great. But what I'm saying is, no, you could never take a loan out on a universal life insurance contract. And if the floor was 0, meaning the market did terrible and it tanked, you still have to pay your fees. After your fees, you still lost 2 or 3 or 4%. Your cash value is lower than it was the prior year. That's not guaranteed against loss, right? To me, that's contradictory, right? So I don't get into things that don't make sense. To me, that doesn't make sense. If it's a guaranteed against loss, why did I lose 3 or 4%? Let's call it what it is. If it says 12 and I made 6, that's not 12. Okay. Now, the other factor in this too is a universal life insurance contract has something called a surrender charge, which means in the first, depending on the policy, the first 3 years, the first 5 years, the first 7 years, the first 10 years, if I borrow against the policy or if I take money out of it, I'm going to pay a surrender charge. This surrender charge usually starts in the realm of like 7 to 10%, depending on the policy. And it goes down usually by about 1% or 2% a year. So it's kind of like a reverse ladder. You go down the steps over time. Okay. Which means that I'm losing, if and the whole purpose of life insurance for me is the banking concept. I'm going to put money into it. I'm going to borrow that money out of it and I'm going to use it immediately to pay off debt, to invest, to do all of the things we talk about with using the sacred account. I don't want to pay a 10% surrender charge the first year to do that. I don't want to pay a 7% surrender charge the third year to do that. I don't even want to pay a 5% surrender charge on the 5th year to do that. I don't want to pay any fees to access my own money. To me, that contradicts the entire thing, which doesn't mean universal life is bad. It means for me, it does not do the thing I need it to do. Right? When I use the sacred account, if I put $1 into it, I want 70 to 90% of that dollar to be available on day one. I want it growing at a guaranteed against loss plus guaranteed growth. I know my compounding annual growth rate is going to be 3 to 5%. I know my insurance costs are not going to go up. I know I don't have surrender charges. I don't have to worry about all this bullshit, right? The options and the calls, the puts. I just know that I'm a partner, right? Whatever the insurance company does to me, they're doing to themselves. That's not the case on a universal life policy. I'm not a partner. They make money whether I do or not, right? Even if I lose, they still are going to make the money. Okay, on a whole life contract, if they're less profitable and my dividend goes down, like they're impacted by that. So they're incentivized to be more profitable. They're incentivized to pay out a higher dividend because it means their company had more profit because I'm an owner in the company. I'm not an owner in the company on a universal life contract. Okay, so with this being said, this doesn't work for the banking concept. Okay, the other thing to worry about too is, again, like if I'm borrowing on a universal life contract, just like with a whole life, theoretically, you could take loans, right? So when I say it doesn't work for the banking concept, I'm telling you it's not optimum. It's not designed for that. That's not the reason or the purpose of its existence. Doesn't mean you can't take a loan. Let's say you take a loan on the cash value. Well, if you're taking a loan on the cash value, let's say your interest rate that you're going to pay is 4% interest to borrow the money, okay? But then you have a down year, 0% floor happens. They still take out the 3 or the 4% fee, right? So I'm paying 4% interest plus a 4% fee. I just lost 8% of my cash value. Okay, like theorizing if I was paying the fee, the interest from the cash value. Otherwise, I paid 4% out of pocket for my interest, and then the rest of it was the fees, plus my cost of insurance went up. Right? Like if we draw this out on paper, what it looks like is we have my cash value, right? And instead of being profitable, let me put my screen back on here. Instead of being profitable, I'm crisscrossing, meaning my rate of return went down and my costs went up. I don't ever want to see this crisscross. On a whole life contract, I know for sure I'm going to make 3 to 5% compounding annual growth rate tax-free. For sure. It's like I can look back 150 years and see that. Right? With the universal life insurance contract, unless it's the Transamerica one, I can look back till 2012. Right? The year I graduated high school, like I have 10 years of track record. It's no different than Bitcoin in that respect. It does not have a good track record. It's not established unless it's that one or the two that Transamerica had that's 20 years old or 30 years old at this point. But the rest of them, they're Me Too products. They came out, in 2010, 2011, 2012. Right? So this is not something that works for banking. Speaking of banking, when we talk about the whole life insurance contract, there's something called bank-owned life insurance. I talk all the time about how banks put 20% of their tier one capital. I think it comes out to $180 billion in life insurance. It's not indexed universal life. They're not buying IULs. They're buying whole life, right? So when I look at, again, what are wealthy corporations, banks, individuals actually doing? It is not IUL. IUL is a middle-class product. UL is a middle-class product, always has been, always will be, right? I want to look at what are the insurance companies actually putting their money into? What are the banks putting their money into? What are the Fortune 500 corporations putting their money into? And it's whole life. Again, it always has been, it always will be, right? So what is universal life insurance good for? Because again, guys, it's a financial product, so it's not bad, it's amoral, right? So this isn't one of those, oh, IUL is a scam and everyone that sells it is evil videos. This is saying, this is the purpose of what I do with life insurance. High cash value, borrow against it, earn the arbitrage, get the positive spread, guaranteed against loss, guaranteed to grow, right? It's an alternative to a savings account that I can borrow against and be my own bank. I can't do that with IUL, so I don't use it, right? What would IUL be used for? The best way that I can describe this is it's an alternative to a Roth IRA. Like we've had a couple in the comments say, you're going to overfund it. That's true. You're going to overfund it. And then it's going to build up over time and it's going to hit a certain peak. And then you're going to draw off of it for income and retirement tax-free. Right now, this goes back to philosophy. And this is why you guys watching, you need to be buying into strategies and philosophies, not products, right? A product is just a tool, right? I relate it to this: work out and eat a good diet. And it probably doesn't matter what supplements you use. You're going to be in shape. Right now, you can use products, you can use supplements to enhance, right? And everyone has their own brand and they all do different things. And there's a whole world of that. That's the equivalent of financial services. If you basically earn, save, and invest, regardless of where, you're probably going to do okay. Now there's different products and tools and things you can use. Life insurance would be one of those. Index universal life insurance would be one of those. So if you're using IUL, okay, this would be the accumulation or appreciation model. If you're a client of mine, you know I'm not a fan of the appreciation or the accumulation model. This is the theory that, you know, I have a retirement age, let's say it's 60 or it's 65, and I'm going to accumulate a certain nest egg. And by that age, I'm then going to draw off that nest egg for income, okay, by selling it. Sell the nest egg. Right? Which is the lifestyle of, I hope I die before I run out of money. Okay. Not something I'm on board with. So whether this was a mutual fund and we're putting into a 401k account so you can retire when you're 60, I would tell you not to do it. If it was a bank account and you were saving in cash until you turn 60, I would tell you not to do it. Right? If this was gold and you were going to buy gold and sell it all when you turn 60 for income, I would tell you not to do it. Why? Because why would you do the accumulation model when you can do the income model? Meaning you get passive income that exceeds your savings, expenses, and taxes, and you can be financially free now. You don't have to wait till you're 60. Not only that, you don't have to sell the assets off over time to generate income. Because what happens when I run out of things to sell? I run out of income, right? If I do the income model, I don't have to sell anything, which means there's no risk of me running out of money, which means I get to enjoy life sooner now because I have passive income now, not when I'm 60. And then I don't have to worry about when I am 60. I hope I die by the time I'm 86, because that's the longest I have projected to have my cash value or my investment account or my 401k account there. Right? Like, and I want to tell it to you this way. Most insurance guys, most financial guys do not know this exists. Like, and I take it for granted. You as clients may take it for granted. Those of you guys that are watching that, you're like OG Wealth Dynamics clients. Do you remember the first time we showed you what we did and we replaced the business of your old financial advisor and how they acted when they saw what you were doing? Because they had never seen it before. I related to bringing a gun to a knife fight before guns were invented, right? So 90% of them don't have any understanding that there's a way other than the nest egg. Guys, the nest egg is a new concept. It's since, you know, the 401k happened and defined benefit plans went away and defined contribution plans started, and the risk of retirement got put on the individual and the family. It used to be income. It was pensions. It was business interests. It was all these things that would pay out over time. Then corporate America said, nah, we're done. We don't want to do this anymore. It's too expensive. We don't want to spend the money. We can make more if we just put the responsibility of retirement back on the worker. Okay, so all of these, index universal life insurance, variable universal life insurance, the 401k, the Roth IRA, these are all the offspring of the accumulation or the appreciation model. Let's buy a bunch of things and hope they go up in value over time. So when we turn 60, we can sell them and hope that we die before we run out of things to sell. We're not doing that game. That's not the wealth dynamics game. And so that's why I would never do index universal life insurance, right? Now, if I didn't know this existed, maybe, right? But at that point, I'd be looking at, okay, well, I'm more of an aggressive investor. If I was going to go like full on mainstream financial insurance, I would probably just buy term insurance and put everything in Vanguard, right? Now, I think that's a dumb idea. I don't do stocks. I don't do term. I don't do that. But I'm saying if I was that guy, and it was just about how do I get my nest egg the fastest, I don't think IUL gets me there the fastest. It might get me there safer, right? But most people aren't looking at that. They're just like, what can I put my money into and never think about again? Right? So that's the big difference there. Now, the other factor as well is when we're looking at, these different models, is what do you actually like better? Okay. Like, what do you personally, do you want to retire when you're 60? If so, my plan's not for you. Right. We've had to tell clients like, hey, sorry, like after a couple of weeks of working with them, we realized you're not a good client for Wealth Dynamics. We're not a good company for you. Your goal is to do the nest egg thing. We don't believe in that. We don't do that. Let's amicably split. Right. But if you're like, well, I don't want to pay off my debt in the next 18 months. I don't want to build 6 months in reserves. I don't want to become solvent. I don't want to learn about private placement investing. I don't want to become my own bank. I just want to stick my turkey in the oven and set it to 365 and pull it out in 45 minutes and it's supposed to be done. I don't want to look at it or touch it. Then you probably should be doing something like this: mainstream financial services, retail, right? That's why it's there. It's a consumer financial product. Okay. Now that's not what the banks are doing. That's not what the 1% are doing. But again, that's why the 1%, they use family offices, not financial advisors. There's producers and there's consumers. If you're identifying as a consumer, probably don't get into the producer plan. If you're identifying as a producer, I'm telling you, the consumer plan is not going to do it for you. Okay. I've been there. I've done that. That's where I started my career. And I'm telling you, it doesn't work. For you being financially free in the next 10 to 15 years, this will not get you there. Okay. What Wealth Dynamics teaches, that does. I'm a living, breathing example that I've clients upon clients that are examples of that as well. Okay. Now, the other thing that I want to get into is when I talk about investing, right? One of the first things that I talk about is only get into things that I like, things that I understand, right? Things that fit me, things that fit my goals, things that are not overpriced, and things that are vital. And the way that I get these little bullet points is the word investing at its root means to clothe your capital. To clothe your capital. So when I wear clothing I like, I wear clothing that I understand, I wear clothing that fits me, I wear clothing that fits my goals, I wear clothing that is not overpriced, and I wear clothing first that is vital. I'm going to wear underwear before I wear a Gucci belt, right? I'm not going to run on commando and be like, would you see my $300 Gucci belt? While I'm chafing, right? So I don't like the appreciation model. I don't like the stock market. I don't like speculation. I don't like options. So for me, IUL does not check that box off. Okay. Now I understand it well enough to break this down for you and to do it in a way that's not, I think I did this in the most objective way possible. I've seen some videos where it's like they make IUL to be the devil, and they make everyone that sells it out to be one of the devil's demons. That's not true, right? So I tried to keep this pretty objective. I understand it well enough to explain it to you, but I don't understand it to where I'm like, okay, yeah, if I had to do this myself, I could, right? Don't understand it. It doesn't fit me. As an investor, this is not my personality. That's not what I like. That's not what I'm interested in. It does not fit my goals, right? My goal is to be financially independent now, not when I'm 60. It's not underpriced. It's one of the most overpriced financial products out there. When you take the total cost and you look at all the fees you pay, it's expensive, right? And it is not vital. It's not something I need. It is not something others need. So for me, it doesn't check off any of these boxes, which means I would never put money into it. I would never tell one of my clients to put money into it. I would never recommend it. And the other thing is, I don't think most families understand. This is the big one I'm gonna focus on. I don't think most families that own indexed universal life insurance truly understand what they have. Okay. Again, it's amoral. So I'm not going to say it's good or bad. It's like a shoe, right? You can't be like, that's a bad shoe. It's not, it didn't shit on the floor. It's not like attacking. It's a shoe, right? It's a life insurance contract. So it's not like it's a bad thing, but it's something probably 90% of people that own it don't understand what they have. Okay. Not only that, 90% of the agents selling it don't understand how it works. Okay, they're like, and there's agents that there's different levels of being a life insurance agent. For all of you guys that have been on the opposite end being sold to by the new friend or family member that joined whatever agency or whatever multi-level company that sells insurance, and you're the one being pitched to, realize your buddy just started. He doesn't know jack. He's repeating the scripts he learned from his sales manager. His sales manager probably also doesn't know jack. He's repeating the scripts he learned from his sales manager. Right? Like the people that actually know how this works are the corporate executives, not the people you're seeing face to face. Okay. The insurance agents, the financial advisors, they are distribution in the sales force for Wall Street, for banks, for insurance companies. They only know so much. Okay. I'm an exception in the industry, someone that actually, I don't sell the stuff and I can explain it to you because it's my job to know it. And I'm interested in finances. So I study it. Right. But the average agent doesn't know. So if you're like, man, my buddy just got into, Ed Milet's company and I love Ed Milet. He wrote a book and he spoke at 10X and he's motivating, has a jet. I should buy their product. That's not a good reason for you to invest in anything. It wouldn't matter if it was, if it was a house or vitamins and supplements. You should never be like, I'm buying that because I like the figurehead who represents. That's not especially with finances, that's a terrible way to make decisions. Right? Same thing with, the guy goes to your church. Oh, that's my friend, our kids go to school together. Guys, I can't tell you how many friends that I've seen that have been ripped off by their friends, by their own family members unknowingly, because the family member didn't understand what the hell they were selling. They didn't know how it worked. Right? So you have to keep your own personal ethics in on these points, meaning you don't sign up for things you don't like. You do not do things that you don't understand. You don't get involved in things that don't fit you. You don't get involved in things that don't fit your goals. You understand the market of whatever you're buying well enough to know when something's overpriced and underpriced. And you understand supply and demand well enough to know when something is vital, because your insurance guy is not. Okay. He's making a commission. He's going to tell you whatever he's got to tell you to get you to sign up for the thing. Right. And I'm not saying commissions are bad. I make commissions, that's part of sales, but I'm telling you, that is still a vested interest. When you talk to my people, when you talk to me, we're not like, oh, this is the greatest thing we're willing to, do your research. Here's some articles you wrote. Here's plenty of videos. Here's content. Here's the pros. Here's the cons. Here's some testimonials. You can actually figure it out and be like, okay, on my own merit, this is a good idea. You're not like, well, Jerry said, right? Like, hopefully that's not you. So when you get sold this, first thing I want you to realize is it doesn't mean it's bad, but it does mean you need to look at these points, right? If it is something that doesn't fit you, if it is something that was designed poorly, if it is something that you thought, is bad based on, your understanding of it, it probably doesn't mean the agent who sold it to you was bad. It probably means they were, a brand new, basically a motivated idiot, right? They're excited. They don't know what they're doing yet. They don't have any knowledge. They just know they're supposed to call all their friends and family because they make a big list when they sign up. And then they're going to say whatever their script tells them to say. They weren't trying to do harm to you. Okay. Right. And then the other thing is, like, there are certain agents that do know this, and they are doing it to make a commission, and they are doing it on purpose. Right. That's a very small percentage of the industry. Right. So it's not IUL is bad and the agents that sell them are the devil. It's IUL is a product that's very complex and confusing. Anyone who claims that it's simple is not actually telling you the truth. It's not a simple product. It either means that they're not telling you the truth or they don't understand it well enough to know how complex it really is. Right. And if they sold it to you, they probably weren't trying to hurt you. They probably just fall into that group of, again, they don't know what they're doing. Right now, I think that's most of what I wanted to cover. Let me think about if there was anything else here. And guys, drop your questions for sure. If you're in the comments here on Facebook, if you're in the comments on Zoom, drop your questions. And I definitely will go through and answer those. Again, the biggest thing here, guys, is like you're looking at the standpoint of what are my goals? What am I trying to accomplish? The other thing I would like to bring up is, again, when I invest money into something, it's got to have at least 3 of these 4 things. It's got to have earnings. It's got to have track record. It's got to have intrinsic value or extrinsic value, right? I would prefer to have all four of these, but I'll settle for 3 of 4, right? So IUL does not have earnings. It actually specifically doesn't have earnings. When you look at the indexes, they don't pay you the dividend. So there's no earnings. Okay, track record. Most of these are brand new products. Okay, they're 10 years old or newer. So the track record is not there, right? Intrinsic value, to a degree, it does have that, right? Like there's a value on the guarantee of the insurance company paying so long as your policy is in force, okay? Extrinsic value, a little bit of that. There's actually something called a life settlement fund. Okay, we created one last year and we'll continue to do more of this as you guys become accredited. It's called the Justice Fund, okay? And so we put this together because all of these contracts, not the index universal life contracts, just the universal life contracts back in the 80s, there's still families today that own these. And they're literally about to get screwed. They're about to lose everything. So what our fund does is it helps them get out of them. It helps them recover as much of their money as they can. And we give them more than the insurance company will give them. And then we take over the premiums. Okay. So by that degree, there is some extrinsic value. You can look at a policy and say, hey, we'll buy it for X amount of dollars. Okay. But it doesn't meet 3 of the 4. Okay. So for me, I'm out. If this was Shark Tank, I would be Mr. Wonderful right now. I want to go ahead and though open this up for questions. So if you're watching this, drop your questions in the comments. If you're on Zoom, we will go live and answer them. If you're on Facebook, I will just do the good old school reading method. And again, if you're like watching this and you're still not quite sure, like, because we covered a lot, like number one is I don't do things that contradict themselves. So when someone tells me 12%, but it's actually 6 or 7, that's a contradiction. When someone tells me 0% floor, but it's actually a 2 to 3% loss, that's a contradiction, right? So just that point, right? I don't do things that don't have track record. I don't do things that the wealthy don't actually do. The wealthy don't actually do IUL. Banks don't actually do them. Fortune 500s don't actually do them, right? And then the other thing too is I look at risk, right? When I'm borrowing against whole life, the reason why I'm okay making that my banking source is because I know for sure it's never going anywhere. Can't lose money, guaranteed against loss, contractually obligated, been around for 200 years, right? IUL is a variable cost of insurance, typically a variable interest rate. I'm sure you can do a fixed option that's more, okay? And then you've also got variable growth. Those are 3 variables. Okay, whole life, there's only one variable, which is the interest rate, which I can make that fixed if I want to and take all the risk out. Okay, variable means unknown. Variable means it could be up, it could be down. There's no way to predict it. It's speculation. When you're doing variable stuff, you are speculating. I'm not a speculator. Okay, so that's my summary. Let me go ahead and open this up for questions. Let me stop my whiteboard share here as well. Bobby says when max funded with minimum death benefit, that is a commonality. If you're doing cash value life insurance, you do want max funded minimum death benefit. There are agents out there to Bobby's benefit, other people that I know that sell IUL, and it's same thing on the whole life side. There are agents out there that will purposefully design these policies incorrectly because when you do a minimum death benefit, you're purposefully reducing your commissions. Okay, like on a whole life contract, I don't know how the commissions work on IUL because I've never sold one. On a whole life contract, the way that I sell whole life pays me 1/3 of what it pays everyone else. To sell an incorrectly designed policy where it's very high death benefit, very low cash value, they get paid 300% more to do that. Right? So there are agents out there that will purposefully sell you, whether it's IUL or whether it's whole life, they'll sell you low cash value, high death benefit because they get paid 300% more money to do that. Scumbags, right? Either that or they're uneducated and that's just what gets taught in their office and they don't know any better. But that's again why you have to be in the driver's seat and understand this stuff. Okay, so Sean King has a question. He says, what kind of life insurance can I get for my mom? She's 73, has had cancer. What are your options? I don't think you probably will be able to get anything on her. You might be able to do like final expense, but definitely not going to be like a whole life or a sacred account type of insurance. When you get into your 70s, like we have, insured clients that are of that age, but you have to have perfect medical history, right? They scrutinize even more because when I'm 70, right, if my average life expectancy says, let's say it's 84, I've already only got 11 years left to live, which means the insurance company will 100% have to pay out a claim in 11 years, so long as I keep paying my premiums. And so they've got a smaller time frame to make up that risk. So most of them will decline. If they do approve, it's going to be very, very scrutinous underwriting, and it's going to be very, very high premiums to offset their risks. Daniel says, would you recommend getting multiple term policies when one is really young, then converting them to whole life once one is making enough to have forced savings? I wouldn't in particular. I would just go right into the whole life. The whole thing, guys, with term, the idea behind term is that you buy like a 20-year term and it's cheaper per month, right? But if you design a whole life contract correctly, it breaks even at like year 7, which means the cash value actually exceeds the premium that you put into it. You don't ever have to put money into it again. It'll just keep earning. That point, your insurance is free, right? So I can go cheap, which is, I paid $60 a month for term insurance for 20 years, and that's cheaper than paying for whatever else, or free, meaning it pays for itself. I've made back everything I've put into it, and I'm profitable on top of it. So I would just go right into a whole life policy with a child. Daniel says, thanks for saving us from our IUL. Dan had IUL. Yeah. So Dan is one of those clients that we helped him get out of an IUL policy. And again, he's someone that probably is a very real experience of like the agent that sold it, what they were like, what they knew, what their knowledge level was versus working with us, right? A totally different ballgame. Justin says, great information. Thank you for my sacred account. You're very welcome. Okay, we have a question. What's the best policy to put lump sums of money in and that I'll be able to borrow from quickly? So I would do whole life insurance, Arnold. I would do whole life insurance. Now, quickly being you can take the loan quickly. The underwriting is not quick, especially right now during all this weird COVID stuff. Excuse me. It used to take 3 months maybe to put a policy in force. Now it takes 6 to 12. Okay. And that's, again, like insurance companies are still working from home. They're slow on that front. They're not able to do medical exams still. The examiner won't always come to your house. They're doing everything on the back end. So they're very slow. If you're going to do that, you need to think with, okay, if I sign up for one today, it's probably going to be ready to fund in summer of 2022. That's the reality of it, right? Just to give you that to think with. Once it's set up, then it's easy to put money and take it out very quickly. But it's that building your own bank, it's not going to be an instantaneous process. What type of insurance is a sacred account formed from? Again, that's high. It's not just whole life, Justin read whole life, but it's high early cash value, dividend paying whole life insurance. In my opinion, and I'm not an insurance guy, meaning I don't sell a bunch of insurances, but that's the only type of life insurance I would sell. Okay. I would not sell term. I would not sell universal. I wouldn't sell IUL. I wouldn't sell VUL. The only type of insurance I would sell would be high early cash value, dividend paying whole life insurance, because that's the only type I would own. And I wouldn't sell something I wouldn't own. Good. Let's jump onto Zoom and see what questions we have here. So if you are on Zoom, drop your questions in the chat. Avery says, used to hearing about warrants instead of options. Avery kind of lives in that world, but yeah, it's like one of those things where unless you do that professionally, it is very hard to understand options and calls and warrants and futures and all this different stuff. Mark says, I understand options enough to stay away from them. I only sell puts on a rare occasion. Very good. I don't do options at all. So Nano has a question. I'm going to bring Nano on live just because his question is a little bit longer. So go ahead and jump on the mic here, Nano.
Hey, Jerry, what's going on, man?
I'm good. How are you tonight?
Doing good, man. Thanks. I was just making some notes to make sure that I got the similarities and differences from the universal life, universal variable life, and index universal variable life.
Mm-hmm.
So the similarities that I got is that all three have what is called annually renewable term.
Correct.
Is that correct? Good.
That's correct.
Universal life, the performance, it is based upon interest rates.
Yep.
Good. Universal variable life, their performance, it is based on the stock market.
Correct. Yep.
And they also have fees.
Yep. They have, mutual fund management fees, loads, all of the normal stock stuff.
Very good. And the index universal variable has the performance. It is stock market, quote unquote, based, right? When it
Correct.
goes up, you have a participation rate. You have a cap that you max it out. Also, you have a floor that in theory, you cannot lose it, but because you have fees, you actually ended up losing money.
Right. That can happen on the downside. The other thing that I forgot to mention is the insurance companies can and do change the cap. So they'll start it really high to get a lot of people in. And then each year they're allowed to lower it. And they do. So it might start at 12 and then they'll say, hey, it's going to be 10, it's going to be 8, it's going to be whatever. So they have the ability to do that.
Got it. So even in the best case scenario for all three, they have their premiums that keep rising year over year that ended up cannibalizing the policy.
It can, yeah, it can when done incorrectly. In most cases, it does, but there are ways to protect against that. But the bottom line is you're making 6%, right? That's the compounding annual growth rate on most of these policies. 6% is not a lot, and there's a lot of risk and a lot of things you've got to figure out in order to go make that 6. You can do better and easier elsewhere.
Got it. Okay, so I just want to make sure that I had duplicated all those intricacies correctly.
Awesome. Yeah. And guys, Nano is a sharp guy. He duplicated all of that because he's licensed. He's studied some of this to give you, some context. Again, if you're the average guy or girl that's buying this, you probably don't have the basis that Nano has of knowledge. And so it's going to be even harder for somebody to understand and actually be like, yeah, I have full knowledge, responsibility, and control over this thing. I just don't think that that's real.
And just FYI, Jerry, you had actually explained this 3.5 years ago in Alaska. I vaguely remember, but just now I'm able to duplicate it.
That's awesome. So that just shows you how long it takes to really get that. Good. We have a question from Patrick. Let me go ahead and bring Patrick on live here and we'll answer his question. All right, we're live with Patrick. How are you tonight, Patrick?
Good. How are you? Can you hear me?
I can. Yeah. Can you hear me okay?
Yep.
Awesome. Awesome. What is your question?
I've never had life insurance. 49, small business owner. Actually did have it for a couple of months, but had to let it go. But better financial situation now. But what do you recommend?
Good question. So it really depends on what you're using the life insurance for. If it's like, hey, I need to get a death benefit to cover, if I pass away prematurely or to buy out a business partner, there's a lot of reasons to have a death benefit. I typically will still go with whole life. Sometimes term makes sense. If you're like, hey, I want to do the becoming your own bank, being your own personal banking system, that's where I would do, again, the high early cash value dividend paying whole life insurance. And again, there are certain companies specifically that design for that. And that's another point, just kind of what Patrick mentioned here that had me think of this, is use things for what they're intended for, right? If an insurance company designs a product and it's not intended to be a sacred account, it's not intended to be your own personal bank, you might be able to use it like that, but it also kind of be like eating steak with a spoon, right? Technically, you probably could do it, but it's going to be very difficult and inconvenient. So Patrick, I would connect with Nano Aquino on my team, and he can give you some information on the sacred account and on how that works. Again, that's the high early cash value dividend paying whole life insurance. And he'll be able to give you some better understanding of what your options are there.
Cool. Thank you.
Yeah, absolutely. All right. Lots of questions. Let's see here. We have question from Aaron Lease. Let me see if I can bring Aaron on here. All right, let me see if I can bring Aaron on live. Hey, Aaron, can you hear me? Oh, sounds like Aaron has a sleeping baby. So I will mute Aaron and just read her question then instead. So Aaron says, my husband and I have some type of UL. Let me bring her question back. We are aware that it's probably not the best. So if we want to start a different type of policy, is something we can do to get out of the existing policy, like a rollover of some sort, or do we just cut our losses and start from scratch? So that's a great question, and that's a common one. So when you have a life insurance policy, if it's a cash value policy like a universal life or a whole life, if you've built up cash value in it, and oftentimes you have to check and see if you have or not, you can do something called a 1035 exchange. I always get that mixed up with a 1031 exchange in real estate, but a 1035 exchange, and it allows you to transfer the cash value from one policy into the other one. So in theory, you could be able to do very similar to like a rollover, right? Now you want to make sure that the policy it's going into is properly designed. So again, I would connect, Aaron, I would connect with Nano Aquino on my team here. Nano can get with you and find out what you have, give you some information on the life insurance options and how you could possibly roll that into a new one. There are things you want to be aware of, like fees, break-even points, different things that are going to be factors, but Nano will be able to talk you through all of that. All right. I think that's all the questions I see on this portion. Okay, Mark has a question. Mark says, is it worthwhile to do a 1035 on an old UL policy to a whole life policy? Mark, it very well could be, right? So it depends on, again, like if you're willing to fund it, right? So if you're doing a new whole life policy, again, it's usually, funding it for 7 years or 10 years or 20 years. And that's kind of your funding commitment. If you're willing to do that, then you definitely could roll it into the new policy with a whole life instead. If it's an old UL, like depending on how old, right? If it was one of the ones from like the 70s, 80s, whatever, I probably would try and get rid of that thing. If it's like a old one, meaning it's like from the early 2000s, it's probably not as bad, but it's still probably not doing very well either. So that's something you could look into. You want to just be aware. 1985. Okay, Mark, we might want to look at that. There are definitely ways to roll it, but we want to look at your in-force illustration, your contract, and see if you're able to move that. All right, very good questions. I think I see a couple more here. Okay, Keith asks, how do I find out what banks invest in? There's not a conglomerate of information for that. So you basically have to go read their balance sheets, right? If you want to figure out what Bank of America invests in, go read their balance sheet and their financial statements. If you Google bank-owned life insurance and you want to just look at the life insurance aspect of it, there are reports that companies have put together that show the total of bank-owned life insurance in the United States. Again, I think it's like $180 billion, which is quite a bit. Just on Bank of America, last time I saw their balance sheet, I think they had $22 billion just in whole life insurance cash value. So those are some resources to look at there. Lamont says, for a person in a wheelchair, what do you suggest? So Lamont, that's a good question. So we would have to do some preliminary underwriting and find out if an insurer would cover an individual in a wheelchair. I think it depends on the circumstances as to why that is the case. Typically, if it's like a medical incident and it's old, like it's like, hey, 10, 15 years ago, this happened, and because of that, I'm in a wheelchair, but it's not an active thing I deal with as far as the medical side. Oftentimes, you'll still be fine. But if it's like an active chronic symptom or a thing that's still occurring, usually it's going to be hard to get coverage in that kind of scenario. So I would find out, which insurers will cover you and maybe give some details on what's going on. And then we can kind of do some research and find out if we have anyone. If we do, awesome. If we don't, you can insure other people, right? So if you want to open a policy, but you can't insure yourself, you can insure others and you're just the owner and the beneficiary. So that's also an option. All right, good questions. Let me see if I have anything else on Zoom. I'm always blown away on life insurance. Like there's always a lot of engagement and interaction. And to me, I just perceive that most people think it's a boring topic, right? But I guess when you're talking about it from the standpoint of being your own bank, it definitely is more exciting and more fun to talk about. Good. I think that's all the questions. So guys, what I'm going to do is sign out here. If you are watching this and you would like to learn more about the Sacred Account, you'd like to learn more about how to become your own bank, you can go to jerryfetta.com/B2F. That's the letter B, the number 2, the letter F. And you can get a copy of my book, Blueprint to Financial Freedom. There are several chapters that focus in on using whole life insurance as a bank. There's even a chapter that focuses on universal life insurance and how we use that as a investment opportunity to buy it away from people that are in a position of losing everything and helping them out as well. So you can do that. If you would like to learn more about life insurance, my thoughts on universal life insurance, whole life insurance, whatever it might be, Patrick says he got the book. It's fire. That's dope. Thank you, Patrick. If you would like to just learn more about universal life insurance, you can reach out, email me, right? Send me a message if you're an agent. Again, not going to debate you on it. I'm not your upline. I'm not your general agent. This is my viewpoint on it. If yours is different, so be it. You've got to make your decisions on what you sell and what you offer, just like everyone else does. But that is all I have for tonight. Thank you for watching. Make sure that you like, share, and subscribe. And I will talk to you all next week.